Okay, so I think it's worthwhile to spend a little bit of time on talking about commercial mortgage-backed securities, CMBS. So I'm just going to walk through how these uh, bonds, essentially, they are bonds. This is a way of financing mortgages through the issuance of bonds to the capital markets. So I know that's a mouthful. Let's go through and just walk through how this works, and then hopefully you'll come away from this video understanding a little bit better about how the capital markets are involved with the financing of commercial real estate. So here we see the typical structure of a commercial mortgage-backed security. Okay, so uh, there are a bunch of loans here. Okay, so these are going to be loans that are given out. These are individual loans that are secured by some piece of commercial real estate. And they're going to have what's called loan originators. Okay, so these are like banks and finance companies. So the bank will, and let's say you're here, you're the borrower, okay, and you're trying to buy some commercial real estate. So you go to the bank or the finance company and you say, "Hey, here's my piece of real estate. I want a loan for it." And if the bank underwrites you and says yes, they're going to basically give you the money to buy it, and they're going to attach a mortgage that's secured by this piece of real estate. Okay. So now the bank has this piece of paper. Okay. Which I guess is represented here, this loan. Okay. So, if this is like, let's say it's a 7-year loan, the bank could just hold the loan for 7 years while you pay it, collect the interest. And they're going to get some principal back, but really at the end of the 7 years, there's probably going to be a big balloon payment when they'll be paid off. So during these 7 years, they can't really give out any more new loans. They're just kind of collecting the income. And so, uh, one way that they can kind of basically take this loan and get paid back immediately so they can make another loan is to access the capital markets. So what they'll do, and okay, so why would they want to do that? Um, they're obviously going to forego some interest because over 7 years, the borrower is going to be making payments and paying interest. So if the bank gets rid of the loan now, they're going to lose that. However, the way the system works is maybe the principal balance of this, let's say, is $100. When they enter in this financial transaction, for one, they're going to collect fees because they will still be collecting the money from you every month. So they'll have some fee income. Um, for one, servicing the loan. This is one of the important parties here. For servicing the loan, they're going to get paid a fee. When you first took out the loan, you probably paid some origination fee also. The bank made money from you by charging you a fee just to start the loan up. The interest is going to be separate. You're going to pay the interest over the life of the loan. But up front, you probably paid some amount just for getting the loan in the first place. So the bank made money there. And maybe they're going to be able to sell this $100 of mortgage to this mortgage pool, and we'll talk about what this is in a second, for maybe 102. Okay, so they can maybe even make a little profit by selling the loan for a little bit more than what kind of the principal balance is. So the fee income, the servicing income, and potentially the capital gain from selling the loan for slightly more is going to incentivize the bank to do this transaction, and then have this $102 basically to go lend out to someone new, and then collect more fee income, more servicing income, etc. So the bank doesn't necessarily just have to collect the interest over 7 years. It can be in the business of just originating. Okay, it's just gonna be originating loans. Now, let's say it decides that, hey, I want to enter into this transaction to access the capital markets to kind of sell this loan, essentially. So what it will do is it will take the loan, and this is a legal entity. This is a trust. Okay, so this big square here uh is a separate legal entity. Okay, so it's a trust. Sorry, this is not the trustee. It's a trust. This is a okay. So the bank will sell the loan essentially to this trust. It's now going to be sitting in this pool of mortgages, and then if it has other loans it wants to sell, if other lending institutions, other originators, they can also sell their loans, and they're all going to be pulled together here. Okay, so now this pool is going to have a bunch of loans in it. Okay, from all these different banks, and so it's paid out. Let's say it paid, just to simplify, this $100, it's paying $100 to buy this loan to the bank. Okay, where is it going to get that money? It's going to essentially issue these bonds. Okay, so this is the other side. So these are the assets that this trust owns. Okay, so this is what is contained in there. But these had to be financed somehow. How did this trust pay for all these assets? It's going to do that by issuing bonds. Okay, so these bonds are tranched out. Okay, so what does that mean? They're kind of sections. AAA. This is going to be the safest bond, and it's going to be the first to kind of get paid. So these loans they're risky, right? You may stop paying. You may this loan that it bought may go bad. So the losses are going to be taken starting here going up. So if there is a loan that went bad, this lowest kind of investor here that bought this bond is going to take the first loss. So this AAA is going to be the most protected essentially. Okay. So you're going to have investors for all these different pieces. Okay. They're all going to get sold off. Maybe they're going to get sold to a pension fund like CalPERS. Maybe they're going to get sold to the Saudi Arabian government because they're bond investors. Maybe it's going to get sold to a hedge fund. Maybe it's going to get sold to a mutual fund, right? That kind of manages people's 401ks. So there's going to be a pool of investors that are going to be investing in these bonds. And so they will give, let's say the total assets here is, if this loan was 100 and there's a bunch of them, let's say it added up to 5,000. Okay, $5,000. These bonds are also going to be 5,000. You're going to sell $5,000 worth of these bonds, and kind of in these proportions, right? So 75% is going to be this AAA, and then so on and so forth. But it's all going to add up to 5,000. So this $5,000 you get from your investors is going to be used to purchase these uh, these loans, and then this $5,000 is going to be basically going back to all these lenders that can re-lend it. Okay, because they originally put up all this money to lend to you originally, right? So, but now they're kind of getting it back, and now all these mortgages are kind of owned by all these investors out here. Okay, so this is a way that you took all this aggregated capital between foreign governments, pension funds, mutual funds, corporations also buy bonds. Like Microsoft, Apple, they have large amounts of money just sitting around, so they're going to engage in investing too, just to earn interest. So that huge pool of capital is going to basically trickle into you as the borrower indirectly through this system of commercial mortgage-backed securities. And so this is a way that instead of just relying on the bank's capital to finance commercial real estate, you're also tapping into this big pool of capital here with all these other investors. Okay, so the loan originators we talked about are these, like the lenders. Like if this is Wells Fargo, you went to Wells Fargo to get the loan, so they're originating the mortgage. The issuer, this is typically an investment bank. So what they will do is kind of set up this trust. They will find all these investors that are going to buy the bonds. They're going to issue the bonds. So the investment banks are like Goldman Sachs, uh, JP Morgan, Deutsche Bank, Morgan Stanley. These are all the large investment banks in the country that kind of set all this financial engineering up. Okay. They also are originators. I think there's that lawsuit recently with former President Trump, where Deutsche Bank had given him a real estate loan, and they probably gave him the loan, but then packaged it up and sold it in a commercial mortgage-backed security. But since these CMBS issuers are the ones that kind of package the loans up and sell them. They also sometimes step in and act as the originating lender and then take that loan off of their own books and sell it into a mortgage, just like any other bank would. So the investors we talked about, this is again pension funds, mutual funds, corporations, even individuals like wealthy individuals will have an account with Goldman Sachs where they can buy this kind of stuff. So those are the investors that are kind of in this commercial mortgage-backed security market, and then the rating agencies. Okay, so these are the major rating agencies are Moody's, Fitch, Standard and Poor's, Morningstar. So these are the kind of the Moody's, Fitch, S&P are the three main ones. I think Morningstar is kind of trying to get into this rating agency game. Um, so they will look at this entire structure. They'll look at what loans are in the mortgage pool, and they'll come up with ratings for these bonds. Okay, how all these tranches, they'll decide. Okay, the loans are kind of crappy, so the AAA part is only going to be 65%. Maybe they'll cut this down and they'll say it's only 65%. But really, historically, the rating agencies are paid by the issuers, right? So there's a big conflict of interest. The issuers want basically this AAA section to be as big as possible because the interest rate on them is the lowest. So it will basically you'll be able to finance this pool of mortgages in the cheapest possible manner if you can have a larger AAA or highly rated section. Okay, so um, during the financial crisis, a lot of in AAA is supposed to be like there's basically no chance of losing your money. But during the 2008 financial crisis, the rating agencies just were so co-opted and you could argue incompetent that many AAA rated bonds went to zero because they're the ones that issue the rating. They say this is AAA, this is AA. They're asserting that this is the riskiness of the bond based on their analysis. But many AAA bonds, AA bonds that are considered very safe just went to zero or took substantial losses. So the rating agencies took a kind of big um, reputational hit during the 2008 financial crisis, especially for uh, these types of securitizations, it's called. The securitization is this process of selling loans into a pool, into a trust, and then issuing these bonds to kind of finance the whole thing. Okay, so this is what a securitization transaction is. Um, the rating agencies historically had just kind of rated corporate bonds. So like when Apple wants to borrow money, the rating agencies will look at Apple's balance sheet. They'll see how well their business is doing and give it a rating. And the rating agencies, you could argue, are still good at that. That's a much more straightforward thing. Um, this type of securitization transaction is much more complicated. You have a bunch of different mortgages. The macroeconomic conditions really matter because when one mortgage goes bad, because there's a recession, it's likely that many of them will go bad. So there's like this kind of tying together of kind of the economic conditions with how well these mortgages do. So it's a much more complicated kind of rating to give, and the rating agencies just did a very poor job. Okay, and just to tie this to kind of the real world, this is the prospectus. This is basically a document for an actual commercial mortgage-backed security. So it looks like Wells Fargo is the issuer. Um, and you can see the difference between the issuer and the originator here, where Wells Fargo does give loans out, right? It's a regular bank, but you can see that in the pool of mortgages. So this is going to be a kind of a list of what mortgages are in this particular bond. So you can see LMF Commercial LLC has the most number of mortgages in this particular pool. They have 24 loans that are going in there. Wells Fargo, the bank, has originated 10. So they had given the loans out. Now they're going to sell those loans to this, basically this commercial mortgage-backed security trust. And so you can see there's 61 loans total in this trust. The average uh, loan balance you can see is $12 million. Okay, so the average is 12 million, and the total balance across all of these 61 loans is $748 million. So the total value of all those 61 loans, if you added up the principal balance for all of them, it's $748 million. So this is how much approximately this mortgage trust is going to sell in bonds. Okay, because it's buying $748 million worth of mortgages, and in order to do that, it needs to issue approximately that much in bonds. Um, so you can see also it's giving you some information on the loans. So you can see this is our term DSCR. So it's saying what is the weighted average DSCR across these bonds. And we know that the higher this is, the better. And so typically a commercial mortgage is going to have a minimum DSCR of like 1.2 or 1.3, 1.4. So this is 2.32. Okay, so you could argue that this is, kind of a pretty good DSCR. Um, you'd have to know more information because maybe if they're interest only mortgages, then the payment is going to be low. And so that can be a way that you can kind of artificially boost your DSCR because if the mortgage payment is lower, then for the same amount of income, it's going to boost your DSCR. So yeah, this prospectus is just giving you a lot of other information on the pool, and it's also going to tell you. So if we go up here, it's showing you all the different classes or tranches of bonds that are offered. Okay, so on one hand, on the asset side, we looked at some information on those 61 mortgages. And on the other side, you can see that they're issuing all these bonds. And so you can see this basically the biggest class is this AAA rated $524 million worth of this particular tranche here. And you can see all these lower rated ones. So there's B, single B. And so these are, as you go down, it's going to get riskier here. Okay. So these are the bonds that are going to be issued, and of course they're going to issue them to mutual funds and other investors that are going to buy these bonds. And the investors care about what mortgages are in there. That's why this prospectus has all this information because the bondholder is going to be like, okay, what am I actually buying? And so they're going to see information on the underlying pool of mortgages because that's essentially what's going to be paying the bonds. So as the borrowers of these loans make payments, those payments are going to filter through and pay off the bondholders. And so, just to be clear, the risk of these 61 mortgages is also going to be transferred. So, if any of them go bad, the bondholder and not the bank is going to be responsible because the bondholder is essentially buying these mortgages from the bank and assuming all the risk. So, this whole commercial mortgage-backed security market is also transferring the risk from the banks to the bondholders. And so before the bondholders do that, they want to understand what risk they're taking, which is why this prospectus is going to contain information about the mortgage pool, like the DSCR, the loan to value, all that kind of stuff. So you can see again, the loan to value ratio is here, 55%. So, the bond investor is going to be interested in all this because they are assuming all the risk of these mortgages now.